All right, welcome to classroom. Today we'll be looking at portfolio theory. So under this portfolio theory, we'll be examining its concepts, which are one, meaning of portfolio theory. We'll be looking at who introduced portfolio theory, what are the core area or what is the core area of portfolio theory. And number four, we'll be looking at the key principles of portfolio theory, which are diversification, risk and return trade-off, efficient frontier, correlation matters, optimal portfolio, and then how to compute returns. Okay, so let's start from the meaning of portfolio theory. Portfolio theory is also called modern portfolio theory. So it's a framework for building and managing investments to maximize returns for a given level of risk, or minimize risk for a given level of return, which means that we can, in other words, say portfolio theory deals with the relationship between risk and return. Okay, so who introduced portfolio theory? It was introduced by Harry Markowitz in 1952. So portfolio theory was introduced by Harry Markowitz in 1952. So what is the core area of portfolio theory? So its core area is its emphasis. Do not put all your eggs in one basket. That means you have to diversify. However, when you are spreading your eggs, you have to be smart, which means that if you are combining different types of portfolio, you don't just spread or scatter your money, but you have to check how those portfolio, how they relate with each other so that you can balance, right? Because every investor wants some level of efficiency. All right, so what are the key principles of portfolio theory? We'll be looking at 5 key principles of this theory, which are number one, diversification. So it says by combining different assets, which are stocks, bonds, real estate, for instance, you must check the diversification to be sure that they do not move exactly together so that you can reduce the overall risk without sacrificing much return. That is number one principle. Number two is risk and return trade-off. In portfolio theory, we assume we agree that the higher the returns, of course, the higher the risk. So which means the goal is to find the best balance, right? So the next one is efficient frontier. So efficient frontier is a curve that shows the set of portfolios offering efficient frontier is a curve that shows the set of portfolios offering the highest expected return for a given level of risk. So any portfolio below the frontier is considered inefficient. Key factor is correlation matters. So it's not enough to just hold many assets. The correlation of how they move together matters. That is, the lower the correlation between assets, the greater the risk reduction. And the last key principle to note here is optimal portfolio. That is the point of the efficient frontier that matches your personal risk tolerance and investment goals. The next concept, which is examining returns. Before we go into examination of returns, we need to know that portfolio theory borrows its techniques from statistics, which means since it evaluates the relationship between risk and return, therefore, we'll be dealing with risk as standard deviation and return as mean, which is average. So I repeat, portfolio theory borrows its variables from statistics, which are risk and return. The risk is represented by standard deviation, while return is represented by mean. You must calculate the risk and return of individual investment. So on a very basic introduction, when we say return, security. So the return, taking shares for instance, return on shares can be taken as capital gain plus dividend, which is in terms of value. But if you want to get it in percentage, it becomes capital gain yield plus dividend. We get the answer in percentage. So if we want to calculate the capital gain yield, how do we go about it? We say new price minus old price over old price, then plus dividend, or let's say dividend per share over old price. So this is capital gain yield, while this is dividend. Having said that, then we need to test a practical question. Drop your comment on a, in case you have a question, kindly drop it on the comment section while we examine a very simple question. So let's test a practical question. Okay, here's a question. You bought a stock for $50 and it is now worth $55. During this period, you receive a dividend at $2. Calculate 1. The total return, 2. The capital gain yield, and 3. The dividend yield. Okay, so let's start. So in order to calculate the total return, the formula is simply saying the price of year 1, which follows trend analysis, minus price of year 0, right, plus dividend per share, everything over price of 0, and that is $55 minus $50 plus $2, everything divided by $50. So this gives us 14%. So that is total return. So that's for 1. For number 2, we have to calculate capital gain yield. So the capital gain yield is P1 minus P0 over P0, everything times 100 over 1. So that gives 55 minus 50 over 50 times 100 over 1. That gives 10%. So when we say capital gain, is actually saying that what has been the gain on the market price per share, because the price is currently 55 and I bought it at $50, which means the share price has appreciated by $5, and that gives us trend analysis, which is 55 minus 50 over 50 to arrive at 10%. So what about dividend yield, which is number 3? Dividend yield. So that is dividend per share over the price of the shares times 100 over 1. And that is $2 over $50 times 100 over 1, which gives 4%. So if you look at this calculation, when you add them together, total returns still gives us 10 plus 4, and that is 14%. And that agrees with the answer we got here. So telling you that total return is simply adding capital gain plus dividend yield. So I believe you understand and you are following the workings. Please, if you have any question, please drop it on the comment section. And then the next we're going to look at is how to calculate the returns on the portfolio, the return on portfolio. So You will see that in the next video to calculate the returns on portfolio. How to calculate the return on portfolio. Thank you. Please like, subscribe, and share with someone. I will meet you in the next class. How to calculate returns on portfolio. Thank you.